Hey guys, when was the last time you were scrolling through your news feed and decided to take a peek at a financial story only to read the whole thing and conclude that you just don't know what you just read? It's happened to all of us, but today I'll give you the basic knowledge you need to understand all this stuff well enough even to confuse other people if you're into that sort of thing. In order to understand the mountain of news stories coming at us every day, you really only need to understand a few basic economic principles. The good news is they aren't even that complicated. Once you understand the Fed, interest rates, inflation, and supply and demand, you'll be equipped to digest what you're hearing and to actually use it to make the best decisions for yourself, instead of relying on the opinions of whoever you happen to be hearing at the moment. We'll be focusing primarily on how these terms relate to real estate, but the lessons you'll learn here are applicable across the economy as a whole. Let's start with the Fed. The Fed is what's known as a central bank, which means that it provides funds to other banking institutions in a very similar way to how your bank might give you a loan on a car or a line of credit. So why is this bank so much more important than the others? Well, as it increases rates, all of the money being used by banks across the country for consumer borrowing, that money also becomes more expensive to those banks, and they pass that cost along to the consumer. So while the Fed doesn't directly control the interest rate you receive when you buy a home, the trickle-down effect will always be there. So what's the Fed's role with regard to inflation? Well, to understand that, you need to understand what inflation is first. Inflation is simply the rising cost of goods. You don't have to look very far these days to see evidence of the record high inflation we've been experiencing. At the gas pump, the grocery store, and yes, in the housing market, prices are higher than they have ever been. So how come the Fed doesn't just mind its own business about all this? Well, it kind of is their business, literally. But to make sense of why, it's best to think in extremes. Think back to 100 years ago. In the 1920s, a gallon of gasoline would cost somewhere between 21 and 30 cents. The price of gas has inflated over time to $3.48 today, but so has the amount of money available to the nation as a whole. So in 1920, the average annual income was about $3,200. So that 21 to 30 cents represented a larger portion of a person's income than it does today. When prices inflate too rapidly, though, the amount of money in the economy can't keep up with that price increase, which results in the dollar being less valuable. If this continues, any nation could find itself with worthless currency, which would cause a total systemic collapse of its economic system. This has happened several times in history. One recent example is Zimbabwe, whose dollar started out in 1980 with a US dollar value of $1.25, pretty darn good. But by 2007, one US dollar was equal to approximately 200 million Zimbabwe dollars. That's a problem. Imagine you need a car and you have $100 trillion cash, so you head to the dealership and they offer to sell you a single spare tire from a 95 Honda Del Sol because that's about all you could afford. If that happened, you'd have to figure out some other way to get yourself around, which, in an extreme example, might mean bartering or trading services. Barter and trade is the most ancient economic system, and we don't want to find ourselves back in it. It's important for our financial health to be able to earn an income for the services that we provide and to use that money to purchase what we need when we need it. Otherwise, if you're an accountant and you need to buy a car, but the car dealership only needs a mechanic at that time because money is worthless, you wouldn't have anything to offer that car dealership. So you'd be, as the old Zimbabwe saying goes, screwed. That's what I mean by a systemic collapse of the economy. Okay, so now that we don't want the Fed to butt out, what can it do about it? By increasing interest rates to the banks, borrowing money becomes more expensive across the board, which results in people like you and me borrowing less money, which forces us to spend only what we have, which reduces the amount of demand for goods and services overall. And I mean, let's just think about it. When you could borrow money to buy a car for 5%, you are far more inclined to do that than when that same loan is at 15%. So as interest rates increase, fewer people buy cars and other goods, which results in a decrease in the prices by the providers of those goods and services in order to stimulate more demand for those products so that they can stay afloat. That leads us to our last topic of supply and demand. And don't worry, we'll tie all this back to real life real estate real soon. So all economies boil down to supply and demand because they control pricing. When you have more demand than supply, prices go up, which, as we know, is called inflation. When we have more supply than demand, prices go down, which is deflation. So we all know that the downside of prices going up is that the average person can't afford as much with their income. But the downside of prices going down is that businesses and other institutions that drive our economy at a large scale have less money to produce their products, to innovate, and to hire workers. In fact, this is why a rate hike from the Fed doesn't just slow down inflation, it even results in people losing their jobs. And this is why we hate the Fed. I know it's an emotional roller coaster with those guys. Anyway, we can see that at an extreme, inflation is bad, but so is deflation. And so the Fed's role is to do their best to set interest rates at a level where inflation will remain at around 2% per year. Now, if you want to understand why 2% is the magic number, you can certainly do a deep dive on that. You're also probably a certifiable nerd, which means we can be friends. But for the purposes of this video, let's just say that history tells us that 2% is the sweet spot to keep your economy growing at a sustainable rate. Since inflation has been more like 8% recently, the Fed is increasing rates to slow that inflation back down to 2%. That's why you'll see news outlets reporting on inflation and interest rates together. They're inextricably tied to one another. Okay, so back to real estate. When the average mortgage interest rate was 3%, tons of people wanted to buy homes. That means extremely high demand, which caused prices to soar. But now that interest rates are about 7%, there's far less demand, which is requiring sellers to reduce their price from what they could have charged just a few months ago. So why is everyone freaking out about this shift? Well, over time, supply and demand do balance each other out and keep prices in check, but in the short term, one may adjust more quickly than the other. For example, when the Fed first started hiking rates earlier this year, demand slowed rapidly, but a lot of sellers were still hoping to fetch the kind of prices they were seeing over the last several years. Sellers are now adjusting their expectations, which means that prices are starting to come down, but the average cost of home ownership is still substantially higher than it was this time last year. Here in El Paso County, for example, in October of 2021, the median home at the average interest rate of about 3.14% with a 20% down payment would cost $1,531 in monthly mortgage payment. That same median home today would be only $19,000 more expensive, but the monthly payment would be $2,500 at today's average rate of 7.1%. So what's the Fed's goal with mortgages? Do they want us to get back to the payment we would have had about a year ago for the average house? Probably not, but really it's anyone's guess. See, the Fed doesn't look at housing exclusively as its source of data regarding inflation. It's looking at the price of all consumer goods and trying to slow that inflation rate back down to the target rate we discussed of 2%. The reality is that homes 1 year ago were probably a little too affordable for the average home buyer, and today they're probably not affordable enough. So sellers aren't enjoying the appreciation that they were used to, buyers aren't enjoying the favorable interest rates that they were used to, so everyone is just slowing down with real estate transactions and joining together in their hatred of those jerks at the Fed. So what does all of this mean to you if you're in the market to buy or sell a home? Well, everybody's situation is a little bit different, and your strategy and plan for your life as a whole seriously impact the decisions you should make. We'll talk more about that in a future video. But for now, my advice if you're looking to move is to evaluate why you're moving. What will it do to your daily life? How long do you expect to stay in your next home? What's the stability of your income and your budget as a whole? And of course, if you don't currently own a home, you have to consider that when you're renting, 100% of your monthly housing budget goes to your evil landlord, which means you never see that money again. As a homeowner, though, you'll have the opportunity to build equity in your home, which is the #1 wealth building tool for Americans today. All these factors are why you need not just a real estate agent, but a real estate advisor. You need someone who's willing to tell you that now is not the time, slow it down, or push you to make the right decision when it is appropriate. All of us at the Johnson team are more than happy to fill that role for you. Whether you're thinking of buying now, in the future, or never, we'd love to talk with you about that anytime. Just give us a call at the number below and let's connect to help you build a winning strategy for yourself. Oh, and before you go, if you got any value at all out of this video, please take a quick minute to like it and leave a comment with your light bulb moment below. That will help those internet overlords deem us worthy of their affection. Oh, and if you didn't get any value from this video, no hard feelings. Go ahead and just subscribe so that you can continue to watch me, mock me, ridicule me, and maybe I'll even do better next time. You never know. Talk to you soon.